Here's something most investors get completely wrong about ETFs. They spend hours comparing dozens of funds, overthinking expense ratios, reading white papers, doom-scrolling Reddit threads, and then do nothing. They wait for the perfect moment, and they miss the window entirely. Right now, in the final days of February 2026, there are 3 Schwab ETFs that I believe are sitting at one of the best entry points we've seen in a while. And if history is any guide, the investors who moved before March will be the ones looking back in 12 months saying, I'm really glad I did that. Today, I'm walking you through all 3, what they are, why I like them right now, and exactly how I'm thinking about sizing into each one. Let's get into it. Quick background before we dive in. I've been investing through Schwab for years, and I'm not sponsored by them. I just genuinely think their ETF lineup is one of the best-kept secrets in the low-cost investing space. We're talking expense ratios so low they're almost laughable, broad diversification across thousands of companies, and a track record of returns that have consistently beaten inflation over the long run. The 3 funds I'm covering today cover 3 distinct roles in a portfolio: broad market exposure, dividend income, and small cap growth. You could honestly build an entire long-term portfolio around just these 3 funds and sleep well at night. So whether you're adding to an existing portfolio or just getting started, stick around, because I think you'll walk away with a clear picture of what to do next. ETF number 1, SCHB, the foundation. Let's start with the cornerstone, SCHB, the Schwab U.S. Broad Market ETF. If you want one fund that does basically everything, this is it. SCHB tracks the Dow Jones U.S. Broad Stock Market Index and holds approximately 2,500 of the largest U.S. companies across every size and sector. You get the magnificent 7 tech giants at the top, you get mid-caps and healthcare and industrials in the middle, and you get small-cap exposure on the tail end. Now here's what makes SCHB special compared to similar funds from Vanguard or BlackRock. The expense ratio is just 0.03%. That is not a typo. 3 cents on every $100 invested. The fund's dividend yield of about 1.1% alone more than covers that cost. Over the last 10 years, SCHB has delivered annualized returns of roughly 14 to 15%. That's the kind of number that turns a $10,000 investment into more than $40,000 over 15 years without picking a single stock. And here's why I'm especially bullish on SCHB right now, heading into March. The current economic environment, with pro-business policy signals and a recovering earnings landscape, sets up broad market exposure really well. Tax still makes up about 33% of this fund, and financials around 14%, 2 sectors that tend to perform when business conditions are favorable. The bottom line on SCHB? It's the foundation. If you don't own it, start here.
ETF number 2, SCHD, the income engine. All right, ETF number 2 is one of the most talked about dividend funds in existence, and for good reason. This is SCHD, the Schwab U.S. Dividend Equity ETF. Here's what sets SCHD apart from generic dividend funds. It doesn't just grab the 100 highest yielding stocks, it screens for quality. Holdings must have at least 10 consecutive years of dividend payments and are filtered by metrics like return on equity, cash flow to debt ratio, and dividend growth rate. In plain English, SCHD is holding companies that don't just pay dividends, they earn the right to keep paying them. The result? A fund with a yield of over 3.5%, more than triple what SCHB yields, with an expense ratio of only 0.06%. And because the holdings are skewed toward defensive, cash-generating businesses, SCHD tends to hold up better during market turbulence than the broad market. The thesis for buying SCHD specifically heading into spring: if interest rates start coming down over the next few quarters, which many economists are now expecting, dividend stocks become significantly more attractive relative to bonds. The market tends to rotate into income-producing assets ahead of rate cuts, not after them. That means the time to position in SCHD is now, not when everyone else is talking about it. And if you're building toward retirement, this is the fund that quietly pays you while you wait. Reinvest those dividends for 10 or 20 years and watch what happens. It's genuinely one of the most powerful compounding machines in the ETF world. SCHD, the income engine your portfolio probably needs more of. ETF number 3, SCHA, the growth upside. Okay, last one, and this is the one that I think is the most underappreciated of the 3. This is SCHA, the Schwab U.S. Small Cap ETF. SCHA tracks the Dow Jones U.S. Small Cap Total Stock Market Index and holds roughly 1,700 companies with market caps under $10 billion. We're talking about smaller, faster-growing businesses in sectors like technology, biotech, and industrials. The kinds of companies that can double or triple before most Wall Street analysts even put them on a coverage list. The expense ratio is 0.04%. The fund has over $20 billion in assets under management, and it yields around 1.2%. Now, small caps have had a rough stretch over the last couple of years relative to large caps. But here's the thing about rough stretches. They create opportunity. Small cap valuations are currently cheaper than large caps on a price-to-earnings basis. They're more sensitive to domestic economic conditions, which means they stand to benefit more from any deregulation or domestic policy tailwinds. And historically, small caps have outperformed large caps over long, rolling 10 and 20-year periods. The risk, of course, is volatility. Small caps move more dramatically in both directions, but that's exactly why you pair SCHA with SCHB and SCHD. You get the growth upside without betting the whole portfolio on it. For long-term investors with a 5+ year horizon, SCHA represents the asymmetric upside in this three-fund combination. It's the piece of your portfolio that has the potential to genuinely move the needle. SCHA, cheap, overlooked, and ready to run.
Putting it all together. So let's zoom out for a second and look at how these three funds work together. SCHB is your core. It captures the entire U.S. market, keeps costs near zero, and compounds quietly for decades. SCHD is your income layer. It generates yield, adds defensiveness, and rewards you every quarter in dividends. SCHA is your growth kicker. It adds small cap exposure where the long-run upside tends to be greatest. Together, you're diversified across market cap, investment style, and income profile, using just three funds, all from the same low-cost provider. How you split the allocation depends on your goals and timeline. A more conservative, income-focused investor might do 50% SCHB, 40% SCHD, and 10% SCHA. A growth-oriented investor in their 30s might flip that, going heavier on SCHB and SCHA. There's no single right answer, but any combination of these three is a solid foundation. Here's what I want you to do right now. And yes, I mean right now, not after you finish your next video. First, go look at your current portfolio. Do you have broad market exposure? Do you have dividend income? Do you have small cap growth? If any of those boxes aren't checked, you now know exactly which fund fills the gap. Second, if this video gave you value, please hit the like button. It genuinely helps this channel reach more people who are trying to make smarter decisions with their money. Third, subscribe if you aren't already. I put out investing content like this every week, and we're building a community of long-term, no-nonsense investors. And drop a comment below. Which of these three ETFs are you most interested in? SCHB, SCHD, or SCHA? I read every comment, and I'd love to hear where you're at. As always, do your own research. Talk to a financial advisor if you need personalized guidance, and invest based on your own situation. This is not financial advice, but I genuinely believe these three funds are worth your attention right now. Thanks for watching. I'll see you in the next one.